Everyone, gather around. Let's take a moment to tear apart, in detail, the latest statements made by the man at the helm of New Zealand's monetary policy, Adrian Orr, the Governor of the Reserve Bank of New Zealand, RBNZ. Oh, yes, we're diving deep today into why his words reveal more than just a communication gap, but rather, a fundamental misunderstanding between monetary policymakers and the economic reality ordinary people face. Just recently, during an event at the Peterson Institute in Washington, D.C., Orr lamented that more people don't read the RBNZ's detailed reports or the meeting minutes when trying to decipher why and how the Reserve Bank makes its central rate decisions. Orr's complaint. Well, too many people rely on journalists, those irresponsible reporters cooking up narratives, or financial analysts, the money people, spinning the bank's policies in ways that favor their own speculative activities in the financial markets. So, let me break down the key issue here, Orr feels misunderstood. He believes that the general public, financial markets, and analysts are misrepresenting what the Reserve Bank is really all about. And guess what? He blames some of the misunderstanding on media filters and analysts' biases. The irony of it all. In trying to defend the RBNZ against criticism, Orr indirectly raises a much bigger issue, the economic mismanagement hiding under all this rhetoric. To properly understand what's happening, we need to take a step back and examine Orr's complaints through a broader lens. Orr was met with scrutiny following the August 2023 rate cut, which was quite the shocker. After all, back in May, the very same institution had projected no rate cuts until 2025. Then, 3 months later, boom. A sharp pivot, and out comes the rate cut. Orr's defense. The clues were there the whole time, if only people had read the fine print. Apparently, the tone had softened in July, a shift that was captured in the oh-so-carefully worded minutes of the meeting. While central bank wonks and policymakers sit comfortably in their well-furnished offices debating economic variables, it seems that the average person, the men and women feeling the pain of inflation, high mortgages, and stagnant wages, are supposed to read through dense economic documents before making judgments on the country's monetary future. Expecting the public, or even analysts who must meet tight deadlines, to parse through obscure notes feels like a detachment from the core issue. Poor communication is a symptom of erratic policy decisions driven by a misunderstanding of real-world economic challenges. Let's not gloss over it. The RBNZ's August interest rate cut was like being thrown off the roller coaster mid-ride. The same bank that expressed a tightening bias in May suddenly cut rates several months later. This kind of erratic behavior not only confuses the market but introduces uncertainty into an economy in desperate need of stable forecasting. You see, the tug-of-war between inflation control, economic growth, and housing stability is delicate. In New Zealand, inflation remains a persistent enemy, with annual inflation holding stubbornly above target since 2021. Even though inflation rates have softened somewhat since the peak, pressures are still palpable. Food prices, rent, and necessities continue to soar. Average Kiwis deal with skyrocketing grocery bills and unaffordable housing, while the central bank plays a back-and-forth game with interest rates. The argument for the August rate cut was framed, as usual, in economic jargon, bringing balance, stimulating demand, etc. But in practical terms, what we're seeing is an economic machine nudging levers without an adequate read of the pockets and stomachs of its citizens. People are confused, not just because of faulty communication, but because the policies themselves seem disconnected from the fundamentals. Now let's factor in another reality, people's disillusionment with financial institutions. Here's the crux of the problem, it's not that the public necessarily reads or doesn't read RBNZ reports. It's not even that journalists and analysts might misinterpret complex economic details. It's that the average New Zealander can feel something's off while policymakers sit in their bubble of spreadsheets and theories. RBNZ's unpredictable policy shifts come at a time when people are already profoundly distrustful of financial institutions worldwide. Following a decade of low inflation, easy money, and rock-bottom interest rates globally, the post-pandemic world has been shocked by persistently high inflation. In New Zealand, house prices surged like never before during those low-rate years. Investors feasted on cheap credit, and the housing market boomed to the point where housing affordability in 2023 is still one of the worst among OECD countries. The people who suffer the most from this volatility? Middle-class homeowners who are suddenly facing higher mortgage payments thanks to past rate increases, only to be left dizzy from abrupt shifts like August's surprise cut. And what about the young people who can't afford to get into the housing market at all? They're faced with impossible savings benchmarks while rents eat up a larger share of their incomes. Governments, both in New Zealand and elsewhere, have used fiscal policies to prop up household balance sheets during the pandemic, but central banks have moved like a pendulum. And now, as fiscal support wanes and price stability remains a moving target, consumers are the ones getting crushed. Orr boldly noted that trust must be based on more than just forecasting accuracy, which is fair. But that brings us to a much bigger question: what should trust between a central bank and the public actually be based on? Trust isn't just about the technicalities of a good report or a well-worded monetary policy statement. No, trust is built on perceived economic security and a clear understanding of working people's needs. And right now, there's a chasm, not just in communication, but in the alignment of monetary policy with the real economy. Most Kiwis today are feeling the squeeze. Inflation may have stabilized somewhat, but everyday costs are up, wages haven't kept pace, and anxiety about housing has never been greater. This points to more structural issues, not just trust in whether a forecast turns out right. With OECD data showing that New Zealand's housing prices in 2023 remain among the most inflated compared to income, and workforces across the country continuing to grapple with real wage declines paired with rising costs, monetary policy decisions that remain in their ivory tower theoretical forms do little to inspire public confidence. New Zealand's issues aren't entirely unique. The situation reflects a broader challenge that central banks globally are grappling with. As inflation remains sticky, many countries are stuck in a cycle of tightening monetary policy, raising interest rates, which curbs inflation but puts the brakes on economic growth. For New Zealand, the October 2023 Gartner report expected inflation to still hover around 3 to 4% in 2024-25, even amid slowing growth. We're seeing similar pressures in central banks in the US with the Federal Reserve, the European Central Bank, ECB, and the Bank of England, BOE, where inflation-clouded policy has left consumers footing a larger bill for both necessities and their increasingly expensive mortgages. Let's take a moment to zoom out and compare. In the US, the Federal Reserve mirrored a flip-flop style in their communication over several months in 2023. Like Orr's Reserve Bank of New Zealand, the Fed has gone back and forth, one moment signaling an aggressive tightening stance and, on another occasion, signaling that they might slow hikes to maintain economic growth. Jerome Powell even admitted to the communication challenges. In one speech, he remarked, "The data is uncertain, we're still feeling our way through." In Europe, we see a similar scenario. The ECB increased rates at an aggressive pace across 2022 and 2023 to combat inflation, leading to significant pushback from market analysts in areas like Spain and Italy where inflation effects and economic slowdowns hit particularly hard. Across the globe, this phenomenon illustrates a central policy tension: when should policymakers favor growth over inflation control and vice versa? Orr's statements reflect that the Reserve Bank of New Zealand, much like other central banks, is caught up in its theoretical framework, but abstract communication and sudden policy pivots don't address the real-world anxieties of the public. To fix the trust deficit, central banks need to take an honest, hard look at the economic disconnect between the lived experience of their citizens and their monetary policy. If they don't, monetary policy interventions could lose credibility altogether, making the reactions of businesses and consumers harder to predict and driving policy levers deeper into uncertainty, fueling even more economic instability. The central bank's duty extends far beyond mere technical precision. It's about meeting people where they are. Because without that, today's economic policy, whether rate hikes or cuts, will do little to reverse the political bad taste left in the public's mouth.